For easy, simple, and precise lecture sessions related to BBA, BCom, MBA, and MCom, do like, share, and subscribe to my channel Kanwal Sidhu. The dividend policy basically refers how the dividend should be paid to the shareholders. It determines the division of earnings between the payments to shareholders and retained earnings. Basically, when the business organization designed a dividend policy, it involves two basic questions: that what fraction of earning should be paid and as a dividend, and how should the firm maintain a steady and stable dividend growth rate. So basically we can conclude that dividend policy decides what proportion of the profit will be paid as a dividend and what will be retained as the earnings in the business organization. As we have already discussed, that a dividend is basically a distribution to shareholders out of the profit or the reserves available with the company. So based on this, we can classify the dividend policy into basically four types. The first one is regular dividend policy. So in this case, payment of dividend is at a usual rate is in terms of the time period, which is known as the regular dividend policy. So the investors such as the retired people or economically weaker persons prefer a regular dividend policy, as it helps the company to create a confidence among the shareholders. It establish a profitable record of the company, or we can say it stabilizes the market value of shares of the company. However, it must be remembered that regular dividends can be only maintained if the company has stable earnings. So a company should establish a regular dividend at a lower rate as compared to the average earning of the company. Then second is stable dividend policy. So it means the payment of certain minimum amount of dividend regularly. This stable dividend policy is very beneficial for both the investors and the company, as it enables the company to stabilize in the market. So value of the shares also stabilize, and it is the sign of continued normal operations of the company, and it creates the confidence among the investors. Then the third is irregular dividend policy. So this is basically the policy which some companies follow due to uncertainty in their earnings, then unsuccessful business operations and lack of liquidity sources. And the last one is some companies have no dividend policy. So a company may follow a policy of paying no dividends at a present time because of some unfavorable working conditions prevailing in the business environment, or on account of requirement of funds for future expansion and growth rate. So these are the basic four types of dividend policies. These are the important determinants or the factors that influence the dividend policy of a business firm. The first one is size of the earnings. So if the amount and nature of earnings are stable, a firm is in a better position to pay the percentage of their profits as dividends. Then second is the liquidity position of the firm. So because the payment of dividends involves outflow of cash from your business, so the dividend policy must take into account the current liquidation position of the firm. Then is the legal norms and restrictions. So there are certain kind of legal norms on which the companies have to frame their dividend policies. Then investment opportunities and shareholder preferences. So the management should adopt a dividend policy which strikes a balance between shareholders' preference for the dividends and financing investment opportunities with the retained earnings or profits. And having a large number of profitable projects in hand, a company should give preference to retention of earnings over the payment of dividends. Then most important one is attitude of the management. So as we know, it is up to the board of directors to frame the dividend policies and to take final decision on payment of dividends. Then there are certain contractual restrictions. Sometimes the firm's ability to pay cash as dividends is restricted by certain specific reasons or conditions in the loan agreements. And when the finances are raised from external sources or commercial banks, they impose certain kind of restrictions on payment of dividends. Then second is the profit or stability in earnings. So a firm with large rate of return on its investment will have larger profits. So it can pay more dividend to shareholders as compared to businesses with a lesser return. And last one is inflation. So it increases the, as we know, inflation increases the replacement cost of assets which are being depreciated every year, and funds generated for providing this depreciation may be insufficient to meet the rising cost of assets. Therefore, the management should reduce the rate of dividend during a period of inflation in order to maintain the earning power of the firm. So we conclude that every firm should establish a journal policy about the payment of dividends, and the financial manager should bring a balance between various factors that impact the dividend policy formation.